Now, when we turn to refined products, we want to start with what's happening with the totals. Where do we sit at this point? And as we were saying with last week, we had an artificial number to the upside. So now we have an artificial number to the downside because there's always that offsetting move. And this is looking at gasoline, jet, distillate, and residual. Again, looking at mobility products. So when we look at the current demand level was 14.229 versus last week of 15.184. That's where, again, we're seeing some of that piece in general where we had that overshoot to the downside. We think it's much closer to about 14.8, 14.9. So just below that 15 level. And you're starting to see, again, we're now back down on that rolling 4-week average. That'll, again, take another leg down and get us to kind of where we think we're going to live as we go through the remainder. And you can see 2019 had that big drop down. We think it's just going to be something very similar to that drop down, just a slight dip below where 2019, that rolling average was just above about 15.1. We think we'll be at about 14.9, and then to see that kind of go through in general on the back of gasoline coming down a bit. And then when we look at jet fuel, we're going to be some of those overhangs with distillate being that bright spot that we continue to see, which is something that we're going to talk about here, where distillate had a draw of 1.69 million. That's now 19.6 below the 5-year average. And as you can see, it was driven purely by PADD 3. PADD 3 had a drop of essentially 4.09 million, where every other pad had a build. Imports remained elevated, as we were saying. It was going to stay in that range in terms of some of that elevation in general. Here we had an increase to 164,000 barrels a day, which is 23,000 barrels a day more than the previous week. And we're just going to stay within this line as we have more capacity coming through. And as that capacity comes into the Atlantic Basin, which is the best market? Should it go into Europe? Should it come into the U.S.? And that's where we continue to see some of that push. So when you look at the 29-year average, you can see that we typically have increases going into October, and then we start to see drawdowns. Obviously, we had not one, not two, but 3 hurricanes coming through and impacting. Obviously, Ida was the biggest impact when we consider what is the underlying in general. So Ida is that underlying problem that we saw, and that has pulled down more product. Again, as we saw that shift away from just total production, we're making up some of that when you look at imports, but again, our exports are going to remain under pressure. So, and just given where pricing is right now and where storage is, we're going to be incentivized to not export a lot of that distillate. So we're going to have exports remain low, and we're going to have imports remain elevated while refiners try to manage. And this, again, we're going to have to start to see some of this build up as we go into the winter months, because again, if we have a cold winter, natural gas is already tight, propane is tight, heating oil so far is going to be very tight, especially when you think about the grades that are being used and how the competition is really road fuel at this point when you're looking at some of that backdrop of heating oil. When we look at distillate demand, we were saying it was going to be a bounce, had a small bounce. We think it's still going to stay over that 5-year average and continue to have that gradual move higher, but just again ahead of seasonal norms, but just again moving in the same line as the seasonal average. So then when we look at the internet truck stop and we look at market demand for trucks, there's some residual of Labor Day. There's obviously the impacts of multiple hurricanes, because when you're looking at trucking, inclement weather is going to hit a lot of different things. So that's where Henri is going to become an issue in the Northeast, which was coming through. Ida coming up through and then cutting over, dumping a ton of water, impacting a large part of the Northeast. And then when you look at Nicholas, impacting parts of Texas on over, when you look at these through passes, some of these truckers might wait, might take different routes. Again, that's going to come through. As we continue to say, it's just going to go sideways. Loading availability dropped. That's going to start to recover. Again, a lot of that is some of that hurricane as we continue to see rates grinding higher. One of the things that we saw is we had gasoline down almost a little over a penny, and diesel is, again, holding firm when you look at just underlying pricing. So when we look at rail traffic continues on total car loads. It's 4.5% above 2020. A lot of that is, again, coal continuing to see that movement. That's going to remain elevated just given coal-fired facilities are going as fast as they can. That's going to keep their forest products in general, farm products, that's going to stay elevated. Grains were hit by Ida and some of the damage down there. We'll see some of that catch back up. But then motor vehicles and parts, again, that's going to remain a headwind as we continue to see those shortages. And then when we look at intermodal, that's where we see this drop, another drop down 6% versus 2020. So remember, 2020 became a harder comp because you got this spike up. But there's also two residual pieces here. And this was something that I thought was very interesting. And this was from the CAS research that dropped most recently. So there's two sides to it. One, there's labor, which we've talked about. We know that there's a labor shortage, especially on the railroad side, as they've been essentially cutting personnel every year for the last 4 years. And here we are. But there's also a chassis problem. And what is the chassis I'm speaking of when we look at the shortages? So it's a rubber tiered trailer underframe on which a container is mounted for street or highway transport. Class 1 railroad trends have had a rough few months, lagging seasonal trends due in large part to two worsening chassis shortages. ACT research experts expects chassis production to be significantly limited for some time, and the intermodal network is unlikely to be able to adjust to a large shortfall in this quickly. So there's some sizable orders have been placed and manufacturers are on it. Roughly estimated it will take 6 to 9 months before production gets to the point where the shortage starts to ease. So intermodal volumes are unlikely to bounce back quickly. Normal seasonality would suggest high single-digit growth in rail volumes in Q3, down from the 23% year-over-year increase in Q2, but momentum slowed significantly over the past few months as network fluidity has suffered and ship and chassis shortages have worsened. Q3 may still end up with low single-digit growth, but rail volumes may well decline year-over-year in Q4. And that's where Q3, we still saw that growth starting to normalize. And then when you look at 2020, harder comp on the intermodal side, plus some of these shortages, which are going to be a bigger issue as we go through the remainder of the year, especially when you look at the amount of product that comes to our shore and has to be offloaded and moved through the supply chain. So here, when we look out, when you look September, the end of September into October, 39.9% over the previous week, 22.3% over the previous year. Again, just a lot of product continuing to come through. And in segment 1 of the Econ Show, we're going to go into more depth on just what does this mean and how bad is it on a global level, not just looking at one piece of the U.S. And when we look at the heating schedule, so here you have some cooler weather coming into the Pacific Northwest and the West Coast in general, as we get this residual heat wave that essentially will last over the next, through the rest of this week and into next week before we start to see a bit cooler temperatures. That's going to put us closer to like that mid 80s, high, mid to upper 80s. And then even as we get to the other side, we're going to be mid to upper 70s. So still have some of that heat residual, which is going to, again, keep air conditioners going. At this point, we're really not using any heating, so it's not like this is going to mean anything for a residual on heating oil. But this will be something that will be positive for the natural gas side when we look at electrical generation. So now when we flip to gasoline, so gasoline had a draw of 1.86 million. That's 9.8 million below the 5-year average. There were drops across the board. Pad 1 was down 280,000. Pad 2 down 100. Pad 3 obviously the biggest of down 1.8 million. But pad 3 is still 200,000 over the 5-year average. And then when you look at pad 5 had a build of 400,000 barrels, and they're 2.1 million over the 5-year average. So when you look at what is causing this drop, it's pad 1 and pad 2 on the 5-year side. And I was expecting a bit more, a bigger drop in gasoline. I thought we were going to get another 5 or 6 million barrel drop, and then we were going to start to see that level off. And as refiners come back and imports accelerate, you'll start to see some of that build back up. We're still in a drawing profile when you look at the seasonality, so there's nothing too crazy. Here you can see that it's when we start to see this pivot, and there's a little bit of a flat line, and then you start to see some of this stability as we go through the remainder of the shoulder season as the refiners pivot from gasoline to heating oil. Imports were down 261,000 barrels, still 38,000 above the 5-year average, but we went from 899,000 to 638,000. The drop was created by pad 1 with a drop of 277,000 barrels a day. Pad 5 had a small drop of 88,000, still elevated versus the 5-year. When we're looking at some of the different pieces in general, we expect to see some of the shifts. When we're looking at the backdrop of imports versus exports, we do expect imports to maintain their elevated levels into pad 1, but more, especially in pad 5, when we look at what is happening in Asia, we continue to see that product coming through. We're seeing that movement come from Asia into pad 5, and that's going to keep some of that moving forward in general. And then, something just dropped where the Middle East refiners keep pushing more diesel and jet to Europe. Shipments of fuels, mostly diesel and jet from the Middle East to Europe, will be higher year over year in September for a third month. So again, we're continuing to see this trend higher where Middle East refiners are shipping more into the into a market that we used to be supplied by the U.S., but just given some of the backdrops, the arbitrage is wide open going from Asia, from the Middle East into Europe. Then when we look at Gas Buddy data, so according to Gas Buddy data, weekly gasoline demand fell for the 4th straight week to the lowest level since June 20th. Weekly gasoline demand was down 1.6% from the prior week and 3.5% below the 4-week average. And then so far, as we've kicked things off, Monday, U.S. gasoline demand fell 4.1% from the prior Monday and was 2.3% below the last 4. And then Tuesday, demand fell 4.7% from the prior Tuesday and was 2.9% below the last 4. So again, you're seeing it's just normal seasonality. This isn't a huge issue. This isn't a problem. It's just we're seeing that typical slowdown as we go through on a seasonal level. And again, as we were saying, we expected to see just a very essentially step movement down of demand, and that's what we continue to see on the Gas Buddy data. There's some residual, obviously. Nicholas created a problem in terms of people not driving, but you also did have some accelerating and trying to get as much gasoline as possible in case something went down. So you have some of that, but again, realistically, we're past Ida. When we look at the impacts on Louisiana, there's still some some gas stations without fuel. But when you look at the residual of the flooding as it went up and through the Northeast, most of that is now behind us. And even with that behind us, we still have this move down. Or I should say, it's actually even worse if you consider the impacts on driving that it had previous week. But again, it's just more so in terms of just seasonal norms. Here you can see that gasoline fell by a penny. So it went from $3.17.6 to $3.16.5. So you're still elevated. We will see some of this movement down as we get the conversion from the summer grade to winter grade. But then the unfortunate thing on the diesel side is it was flat. So it was 337.3 to 337.2. So again, this is where we continue to see a lot of these impacts when we're considering shipping and a lot of these problems as we go through the remainder of the supply chain in general. So now when we look at blending components, here you can see we're just below 2016, but above 2017. Here you can see that we had that other big drop. But when you look at 2017 and today, they're going to look similar, and that's what I keep trying to describe. It's not that we're going to mirror it exactly. It's just going to have a very similar feel to it as you get refiners coming back. Some of that adjustment from not operating to operating, that's going to replace some of this product that has been drawn down. And when we consider what we've seen so far on the gasoline side, when we look at blending components, so gasoline had a draw of 1.86, but blending components only had a draw of 560,000. So when you look at the differences, so gasoline itself had a draw of 9.8, is 9.8 million below the 5-year average, where blending components, is only 3.6 million below the 5-year average. So you're seeing some of that softness, and blending components is usually a good gauge of what is going to be the next week or two, and because obviously you have to blend it before you can send it to the to the pump, and that I think is going to cause some pause when you look at where some of this demand is going to be over the next 2 weeks. So then when we go a bit further and we look at over the last 15 years, here's that correction that we were talking about. It's accelerated. So typically you get that move down starting here. So again, it's very seasonally normal. It's just that we had that makeup number. And then when we look at where we are, we're now back below 2019. And we're just going to continue to stay a bit below. We will get, again, when you look at 2019, you see that bounce. We will get a bounce. It's just not going to be to the same magnitude that we saw in 2019 and pause closer to 9.1. That between 9.1 and 9.2. When you look at where the seasonal trends are, there could be some residual that's left through as you get that last push to refill post IDA, especially in parts of Pad 3. But for the most part, everything has been normalized through the chain. So there could be some residual. I don't think it'll be enough when you're looking at how the EIA looks at things on implied demand, or based on what is the supply coming out of the blending side, or when it leaves their storage to go into the rack to go to the tanker. Then when we look at the rolling 7-day average, so here is where we can pick up Labor Day. So you got that nice little spike, people going to parks, got that drop in workplaces, transit stations. But then when you look at retail, recreation, things remain flat. Residential still remains elevated. Again, that work from home remains that big caveat. And we do have people continuing to kick to the right, bringing people back to the office. Here, when we look at Apple Mobility, we continue to see some of these slowdowns. We're coming back. Again, we're just cresting back over. Very normal, nothing crazy. It's still elevated when you look at the U.S. in general versus 2020, when we look back to where we were previously. So you're still above 2020. So again, that's where we're saying that we're not going back to those lows, but we're still going to be just below that 2019 level. And then when we look at propane, and shifting a bit. Now, we added a chart here, and we're going to keep this chart going forward because it's very important as we look at politics and how does that deviate going through the winter months. So here we only had a build of 720,000. That's 17.6 million below the 5-year. And when you look over the last 5 years, we're in a very precarious spot as we're already starting to flatline as we go into the shoulder season. And the question is going to be, where are we on the other side of shoulder season when we get that seasonal demand and that seasonal drop? As you can see, that picks up in essentially November and then accelerates through the end of March. Now, the gate that we talk about here is not going to be, at least for now, won't be an issue, because when you look at it, there's 63 days of cover in supply. But when you look at where we sit versus 2017 and 2018, that is not a good thing. And the reason why is when you look at where the DOD or could throw up a gate and block some of these LPG exports, is really how quickly do we get to these lows, because 20 days of cover is where people start to get very concerned. And we got really close when you look in 2018, and that's going to be the concern of where are we versus 2018? Because if we dip to below that level, we're going to come to that again that precipice of what are we going to do? How are we going to manage this? So far, again, this is going to be more of a 2022 impact when you look at January through March, but we can get kind of a semblance of an idea of what that's going to look like as we progress through the end of the year. Then when we look at vaccine doses, here you can see that things remain fairly robust in terms of the rate. Nothing surprising versus last month, steady as she goes when we look at moving forward. And then when you look at just the net amount of people that have been vaccinated, the U.S. full is 53%, 9.2% have one and waiting for the second. So it's just we've seen the pace slow down as a lot of the people that want it have reached those levels. And that's, again, going to slow down the net number of people who are vaccinated. When we talk about Jet, so Jet had a build of 430,000 barrels. We're right in line with the 5-year average. But when you look at the demand side, we were expecting to come right around where that low point was in the middle of August. And, we're right there now. We expect it to have a little bit of a pop, but again, just go more sideways at this point and just and essentially sit just below the 2016 through 2019 and just sit just below that and look, I think, very similar to what we've seen for the TSA data, which we'll talk about in a minute. Global departures continue to increase on the back of Asia Pacific as North America rolls over a bit. Everything from Europe, rest of the world is fairly stable, but North America was slowing. The average of departures was up 1.4%, and that when you look at it, departures in China led growth, while departures in the U.S. led decline. So again, the China side's also going to reverse when you look at the renewed outbreak. So that will put a little bit of a pause on some of that, if you will. Global passenger flight schedules for the 11 weeks ahead declined by 0.6% since last week. Again, just those seasonal slowdowns that we normally see. TSA passengers are doing its thing and doing exactly what we said it was going to do, which was just continue to move down on that seasonal level. And now we think it's just going to be a sideways move from here. Just below 2019, when you look here, we're at 1.272. And then the low point for 2019 was about 1.9. So again, we're just going to maintain that disconnect and just go sideways from here, just as there's less travel in general. Open table, we're now in the throes of the real world on the other side of Labor Day. So here we expect something very similar, where weekdays is going to be down 10 to 20%. Weekends will be 0 to 5%. And we're just going to see things kind of sit like that as we go through the remainder of where you can sit outside, because even now some people are concerned about going indoors. So you might see some of that drop off. But for the most part, we think that you're going to be fairly stable at that 0 to 5% weekends. And then let's call it 10 to 20% down on weekdays. So now in the next segment, we're going to go deeper into the global energy markets and where things sit on differentials and spreads, OSPs, because there's a lot of moving parts in terms of where some of this product is shifting and going to.